Most people focus on paying down their home loan, which makes sense. It's what you've been told to do. But whilst you're doing that, something's happening in the background. Every repayment you make, every year your property value goes up, that gap gets bigger. And that gap is called your equity. Most people just watch that number grow without asking what it could be doing for them. They treat it like something that matters for when they sell the property. But your home loan is a financial tool. And the homeowners who understand that, they're building wealth in ways you might not know about. In this video, I want to show you 2 strategies that will help you build wealth faster by using your home loan. Now, these 2 strategies aren't common conversations. Your bank hasn't brought it up. You might not have even heard of one of the strategies before, but they're legitimate and powerful tools. And once you understand them, it'll be hard to look at your home loan the same way again. Quick note before we dive in. This isn't a one-size strategy fits all. The numbers, the structure, and whether they're even right for you, it depends on your personal circumstances. For example, your goals, your tax position, your income. So please don't take any of this as advice, but take it as a starting point for a conversation to have with your broker and your tax accountant. Most people assume that trying to buy an investment property means that you've got to start saving from scratch again, even whilst you're paying down your current home loan. It can be pretty tough. But here's the thing. If you've already built equity in your home, your deposit and other buying costs might be sitting right in front of you. Here's how it works. Once your equity crosses a certain threshold on your own home, you can then draw a loan secured against your house for the deposit and other buying costs for an investment property. Then we look to buy the investment property and we get another loan which is secured against that investment property. 2 loans, they're each secured against a different property. And here's the part most people don't know. Sometimes it can automatically be set up in the bank's favor, these 2 loans. And this is called cross-collateralization. What that means is they bundle both properties together as one security. So we've got a number of loans all secured against 2 properties as a package deal. In the future, it can make things a bit difficult for you when it comes time to sell one of the properties, refinance one or both. Avoiding this cross-collateralization is in your favor as it preserves your flexibility down the track. Once your investment property has tenants in and it's producing a rental income, that means the interest portion of your loan is now tax-deductible debt. And your equity has now generated a second asset growing towards your wealth. And this is how a property portfolio actually starts. It's not about saving for years and years for a deposit. It's about using equity that's already sitting right in your own home. This second strategy is one that a lot of people haven't heard of before. It's called debt recycling. And it's about taking any savings that you already have or you're building towards and then structuring it in a tax effective way. Here's the starting point. For your owner-occupier house, your repayments aren't tax deductible, but for the investment property, the interest portion of your repayments are. What debt recycling is all about? It's about trying to change over your non-tax deductible debt into tax deductible debt, because now we're going to be using it for an investment purpose. So let's say we've got someone who's been building up some savings in their offset account for a little while. Let's pretend they've got 100 grand. Now, they could just use that 100 grand to go and put a deposit down on something or invest in shares. But what they're going to do instead is they're going to put that 100K as a repayment into their existing home loan. What that does, it's going to reduce the loan balance by 100K, and then immediately they're going to redraw that money back out as an investment loan. So what they've redrawn is now investment debt. And that means the interest portion potentially could be tax deductible. So let's say if that person's owner-occupier loan was sitting at 600K left owing on the loan, they've got 100K in their offset, they pay down that 600K, it becomes 500K. Then they take out the 100K for the investment loan. So they've still got 600K sitting as a loan against their owner-occupier property, but still the same loan balance owing, but we've just changed the purpose of that 100K. If you want to look even further into the numbers, that 100K investment purpose loan at a 6% interest rate is $6,000 for that year of tax-deductible debt. And at a 37% marginal tax rate, that's roughly about $2,200 back into your pocket for 1 year. And then the cycle keeps continuing every year. So the key thing here is that you're not taking on more debt on your owner-occupier loan. You're simply putting any savings you have that you want to invest, you're putting them into your home loan, redrawing them back out so they now have a different tax purpose that can serve you with tax benefits. So debt recycling is all about restructuring the debt you already have. Every dollar that you recycle for investment purpose is a dollar that the ATO now looks at differently. Both of these strategies come back to the same idea. It's that your home loan is a tool that you can be using to build wealth. Using your existing equity to perhaps buy an investment property is a way to more quickly grow your asset pool. And debt recycling is a way to make your savings work smarter. And together, they're two of the most valuable tools that are available to everyday homeowners. There's just not that many people talking about it. If you want to understand how either of these strategies could work for your situation, that's the kind of conversations that we have every day. And the link below this video will allow you to book a time to speak with us directly. No obligation, just a proper look at where you're at, what you've built, and what's possible from here.